Participants, on behalf of PMS Bazaar and White Oak Capital, I welcome you all for today's session. I am Pallavarajan, representing PMS Bazaar, and I'll be your host for the day. Today we have Mr. Prashant Khemka from White Oak Capital, who will take us through by introducing White Oak Capital and their investment philosophy and their views on markets and economy. Thereafter, we will take few questions which you have already received from the participants. So before I hand over the forum to Mr. Prashant, so I would like to give a small introduction about Mr. Prashant Khemka. So Mr. Khemka is the founder of White Oak Capital, currently managing an asset under management of about 1.7 billion USD, which is about close to 13,000 crore in INR, which is investing in Indian equities. He set up White Oak 3 years ago after spending 17 years at Goldman Sachs, most recently as CIO and lead portfolio manager of global emerging markets and Indian equity strategy. So without any further delay, I will hand over the stage to Mr. Khemka. Khemka, over to you.
Thank you, Pallav, for coordinating this, and I want to thank everyone for joining this evening. We are going to talk about, obviously, the topic du jour, which is the pandemic and its impact on the economy and the markets. I would start with stating the obvious, which I'm sure you've heard many times, but it's worth repeating, that it is unprecedented situation with extreme uncertainty of the kind that we have never seen before, and there's no living memory of it. The last time a pandemic occurred was over 100 years ago, and no one is alive or has any memory of that, if you will. There are various scenarios possible, and they are all very path dependent as well. What happens over the next few weeks can change the course, and a lot of new information keeps coming, like it has over the last 2 months, and the possible scenarios keep evolving as well. So for me or for anyone else to have any degree of confidence, I would say it will be very foolish or naive to state or have confidence in a particular outcome. What we can talk about is few different possibilities. Just like when you throw a dice, you can talk about whether it will be 1, 2, 3, 4, 5, 6, but you can't have, and there's no reasonable basis to have high degree of confidence in any particular outcome. So we'll talk about a few scenarios, and to keep it manageable, we'll talk about a couple or 3 scenarios. And to give structure to my commentary, I will focus on these 4 aspects: the pandemic itself, the economy, the resultant impact on corporate profitability, and the market. And again, in the interest of time, would keep my comments limited to India, but if there are questions, happy to answer them, but to the best I can, related to the US or other global markets. To start with the pandemic, and then after I've covered this, we'll talk about how we approach in our portfolios as well at White Oak. To start with the pandemic, and to consider probable scenarios: best case, base case, and worst case. The best case, I would say at this point in time, is for a medicine to become widely available. Let's say in the next few weeks or a month or 2, which is effective. Effective meaning able to reduce mortality from wherever it is by more than 90%. So the mortality is less than 1%, meaning less than 1 in 100. Something is developed that reduces it to less than 1 in 1,000, that will be considered very effective. If such a medicine is announced and is widely available, everything would normalize very quickly, when we'll talk about its impact on the economy and the markets and what. While it seems increasingly less likely with each passing day, such an outcome, best case outcome seems less likely. There still is a, I would say, non-trivial probability that something might come through. There are hundreds of companies working on various trials for potential medications. and we'll come to know the outcome over the coming weeks and months. There is this possibility, low probability at this time, but possibility does exist. Base case scenario, or let me talk about the worst case first. Worst case scenario is where there is no medicine, no vaccine ever developed. And then in that case, this virus would eventually end up touching everyone in the world, more or less everyone in the world, and herd immunity would be developed. And this could happen at a different pace in different countries and regions. I think a 12 to 24-month time period is a reasonable, based on my limited understanding, seems reasonable for this to set in, herd immunity to set in. The human cost would be sizable in such a scenario. But once we are through with it, things should normalize. Obviously, you can always paint a worse than worst case scenario. There is no end to it. But this is, as I said, more probable worst case scenario. And the base case scenario, what we think of at White Oak, is one where there's no medicine that has become available, but a vaccine indeed becomes available and widely administered by the end of next year, calendar 21. Call it 18 months time. So these are the three scenarios under which we'll discuss the rest. For most economic perspective, the base case and worst case, there's hardly any difference. The difference would be in the human cost, lives and whatnot, which is very critical. But I would again limit our conversation today to more the economic and corporate and market impact. So in that context, the base and worst is not much different. Happy to answer any questions on the nuances. So if we think of under the best case, we think moving to the economy. Under the best case, I think this year economy can still grow low single digit percentage point or two, because if medicine is available by the end of June, let's pick a date, then things would quickly normalize, lockdowns would be lifted, people would get back to work. There would be still a lot of ground to cover because of these 3 months of lockdown. Still economy could possibly spring back and deliver for a full year basis FY21. Low single digit growth, call it 1, 2, 3%. And then next year from the low base should provide a 5 to 7% growth. So fiscal year 22, because FY21 is very disturbed year. So we should look at FY22 compared to FY20 in the best case scenario can give cumulative 5% growth. In the base case and worst case scenario, I think both the economic impact would be similar, which would be, call it minus mid single digit, pick a number, minus 5% this year, and on that low base, plus 5% next year, such that the economy in real terms is flat in FY22 with what we had in FY20. So 2 years of missed economic growth. And then from FY23, things normalize again. On the corporate profitability, obviously, we can talk about the overall, but there could be differing impact on different companies, as is always the case. But on the whole, when we think about the best case scenario, we think there'll be some modest low single digit growth still possible for this year, followed by double digit to mid-teens or even stronger potential growth in FY22 in the best case scenario, as the economy normalizes next year. So think of FY20 to FY22 over a 2-year period, potentially 15% growth. Again, missing out 1 year. Whereas in case of the worst or base case, I would say the growth in corporate earnings could be severely hit this year. You could have down double digits, and then on a low base, grow about double digits next year, such that on a 2-year basis, corporate earnings are flat. Again, losing 2 years due to the pandemic. Now, certain sectors likely do well, reasonably well. There'll be very few companies or sectors which, because of the pandemic, do better than what they would have done otherwise. But there would likely be companies who do just as well, or around as well as they would have done without the pandemic. So the sectors that within this corporate profitability uh, uh, that would see sectors that would see better demand environment, I would say would be in no particular order. Telecoms would likely see better demand environment, as all of us, including right now, are working from home. IT services sector likely to do better than, because it's more export oriented, and it is our view that the world economy, the developed world economy, is likely to normalize sooner than the domestic economy. Again, happy to answer questions why we think so. It's just because the testing capabilities, the technological capabilities, the organizational capabilities, as well as the infrastructure for deployment of social distancing are all far advanced in developed countries than, unfortunately, in developing countries. And likely, we feel the economy would normalize there sooner. So in general, export-oriented sectors would likely not feel as much operating pressure as domestic sectors, at the risk of generalizing. So IT sector that way should recover sooner. And I think from a structural perspective as well, the demand for all things digital and remote is likely to boost substantially or multifold, and that also would feed into ultimately demand for IT services from India. Pharmaceuticals is another sector which at worst you can expect things to be as they were with or without pandemic, but likely they're going to see a better environment from a regulatory perspective. The FDA and all would recognize the importance of having smooth supply chain, redundancy in supply chain, and likely be more supportive and facilitating of Indian pharmaceutical generic players than the environment we've seen over the last 5 to 7 years, where these Indian companies have seen a very aggressive FDA figure. These are some of the sectors which are likely to structurally benefit. I'm talking about the bigger ones. There are obviously specialty chemicals and other such industries which may also see a lot of benefit. Some of them may benefit from supply chain moving from China, which is already happening in case of chemicals, but can further accelerate in months and years to come as global companies seek to diversify their supply chains away from China. On the other hand, sectors that are exposed to domestic cyclical demand, they're likely to face greater operating headwinds and demand downside. Obviously, financials are the most obvious one, and automobiles and other consumer discretionary items would similarly face demand challenges. Industrials also being in there, and real estate also. Now, certain sectors like staples are less affected, are in between the two. And then across these sectors, corporates which have strong balance sheets, which is always true in tough times and difficult times, companies with stronger balance sheet tend to hold up better. In the first place, they have stronger balance sheets because they had stronger positions in the marketplace, if you will. And in times of crisis, strong players tend to do better. So all else equal, again, industry leaders in each of the sectors would tend to do better than marginal players. Financials is a particular sector of interest, I know, for all of us, because it was a market darling and now it's beaten up so badly. Now, you can't generalize across financial companies, because there are some financial companies that have very strong liability franchises while others don't. So if you think of after the pandemic, through the pandemic, leveraged companies, and the longer the troubles last, the most leveraged companies would see a survival crisis as well. So amongst financials, the business model itself is leveraged. So some of these companies may not be able to survive, but those that survive over the next 2 years likely thrive over the next 2 decades. So you have to distinguish between financials. Those lending institutions, first of all, there are lending institutions in financials and non-lending institutions. You have to distinguish between. And within lending institutions, those who have strong capital adequacy ratios, those who have a strong collateralized asset book, those who have robust lending practices, i.e. lending to better quality, on balance, better quality borrowers, they should hold up better. And all the others who are vice versa would likely suffer. So I spent more time on corporate segment because the answer is not homogeneous. It is hopefully what I'm conveying here, the answer is very heterogeneous. Coming to the market, obviously the market recognizes all these. So to say anything from everything that I've said so far, to project on the market would be at best a scenario analysis. If things turn out to be much worse, things turn out to be worse than the worst. I think currently what the market is pricing in is the base case / worst case, because that's the most probable outcome. If the best case scenario does play out where a medicine is found, you'll see a sharp jump in the market back to the historical high levels that we'd seen earlier this year. Not just in India, globally. You'll see immediate jump up before the announcement comes and before anyone has chance to react. It's very likely the market would recover 25 to 35%. Basically, it's down right now 22%. So if it recovers 25 to 35%, it would be back to the old highs or the start of the year levels or above them. Otherwise, I think it is pricing in a 2 years of struggle for corporates in India. From sector to sector also, as you all might know, everything that I talked about, the impact on corporate profitability is already reflected. So one cannot extrapolate from the discussion on the different sectors that, oh, financials are in a void, or, oh, pharmaceuticals or IT services are a good buy at this time. No, that's not what I was suggesting when I was talking about corporate profits. Market is already reflecting, the overall sector level dynamics that I painted for various sectors. What really matters is there's no value add from in our view, there's no value add in picking sectors from where we are or at any point in time. Just as we don't believe there's any value add in timing the market. Similarly, there is no value add, we believe, in trying to do top-down sector rotation. So that brings me to the next step, which is what we do and how we approach investing in our portfolios, which is very bottom-up stock selection. And that is where you have to capture the nuances. That is where the market is inefficient, not in the top-down perspective. We are going to come to White Oak's investing approach, and I'll take about 10 to 15 minutes on that, and then we'll open up to questions. As I said, we are very stock selection driven investing approach. The philosophy being that outsized returns are earned over time by investing in great businesses at attractive valuation. I'm not sure whether we have the slides that we can share at this time. In case Vivek is on the call, may be able to share that slide. Slide number 9. Next slide, please. Yes. So the philosophy at White Oak is that outsized returns are earned over time by investing in great businesses at attractive valuations. Two key elements being great business and attractive value. Now, one may think everyone says the same thing. That is true. It's a centuries-old business. There are not too many ways of doing this. It's just like to have a healthy body. You need to eat well, sleep well, exercise, and have a stress-free life. And same is true for investing as well. But the devil lies in details and execution. So what we consider as great business is one that has these attributes of superior returns on incremental capital, so looking forward capital, scalable and well managed, both in terms of execution and governance. These are born out of the fundamental value equation that value of any business or project is equal to the present value of future cash flows, which is often written as enterprise value is equal to cash flow divided by R minus G, right? So to generate any cash flow, it is prerequisite that returns on incremental capital are higher than cost of capital. I'm sure everyone can relate to that. If you can't cover your cost of capital going forward, you cannot have sustainable cash flow generation, and hence there is hardly any value in such a business. The higher is the return on incremental capital, the higher compared to the cost of capital, higher is the cash flow generation. That is point number one. Second, very importantly, is scalability, which is whether a business can be multiplied manifold compared to its current relative size to the rest of the sector or the economy. If I were to give an example, and let's take the example of financial sector itself, private banks. Over the last 20-25 years, because all these private banks started pretty much in mid-90s when licenses were given out, these banks have grown, compounded as an industry at close to 20%, because India's economy has grown at about 13% in nominal GDP terms. Credit penetration being low, still low, has grown at a faster pace at mid-teens level. And when we started, more than 90% of the assets were with government-owned banks who are perennially losing market share. So private banks gained market share and grew approximately 20% over this. So that scalability is what we look for as well for outsized returns. Now, when you have the potential, remember, though, you can't compromise on the first point, which is superior returns, because a lot of banks grow at 20%, but then they go bust because they forget the first point, right? So what we're talking about scalability on top of superior returns on incremental capital, not to forget the first point. Now, when you have the potential for cash flows and scalability, you need management that can execute with long-term value creation focus. Again, to stick to the banking example, in the mid-90s, there were many entities that got a banking license, but only a few like HDFC or Kotak and few others have created a value in lakhs of crores of rupees. There are several others along the way that went bankrupt, including most recently Yes Bank that had to be bailed out. But if you go back in over the last couple of decades, you had Bank of Rajasthan, GTB, Centurion, in various forms that had to be bailed out. Right? So assessing the execution DNA of an organization in harnessing the potential for cash flow generation and growth is very critical. First. Finally, governance. I would say not last but not the least, but first and foremost comes governance for the team. It is the only screen that we use, because even if all the other attributes are present, but if governance is lacking, then there is no value or no utility of the other attributes. It may be a great business, but only for controlling shareholders, not for us minority shareholders. And the best way to make money from such companies is to avoid them completely. And that's something the team has done very well over the last many years, and is, as a result, reflected in the performance edge. Now, when you have all these attributes, you must have the discipline and patience to buy at a price that is substantially below fair value to be able to make outsized return from the stock. There are many who say, well, if you can find such companies, you can buy at any price and you hold them forever, and you would be able to outperform the market. While there is some truth to that, a portfolio of such companies would be able to outperform the market. However, as we remind, the team keeps reminding itself, our aim is not merely to outperform the market, but outperform the best outperformers out there in market. So to generate that extra few percentage points, it's very critical to have a strong valuation discipline. When it comes to valuation discipline, we do not look at P multiples or EBITDA multiples or such at all. We may evaluate a company, analyze the company, own it for years, and then sell out without ever mentioning P multiple on the T. What we focus, because P multiples are very distorted, at best they are meaningless and useless in our scheme of things, and at worst, in our view, they are misleading and harmful. So we have a deep-rooted disregard for PE multiple. What we focus instead on is what we call, based on our proprietary capital light excess investment return framework, the DCF value, as well as the capital light price to free cash flow multiple. I'll spend just a minute on the concept. If Vivek, you can switch to the next slide. Given the format of the forum, won't go into details, but just schematically, any company under this framework, call it ABC company, can be split into two entities, ABC Finco and ABC Opco. All the operating assets, the fixed assets, plant, machinery and all that, as well as working capital like inventory and all finished goods and all that, are housed under the Finco. And the revenue and EBITDA of the company are assigned to the Opco under this framework. From the EBITDA, the Opco is then deemed to pay an operating lease cost for use of fixed assets and a working capital financing cost for use of working capital. Then after paying taxes, what is left is what we call capital light free cash flow. And those can be computed for each year going forward. They're called capital light because capital is all residing in Finco. And these represent excess return on invested capital in the business. Right? And the present value of these cash flows represents the value of Opco, which is the value of excess return on invested capital in the business. Whereas the Finco is merely the invested capital or the dumb capital that anyone can pour into a business. So the Opco, value of Opco represents the value that a management is able to bring to the table, either due to execution capability or due to brands or intellectual property or network effect, first mover advantage, whatnot. Think of this, separating these two as equivalent to separating water from milk. Doodh ka doodh, pani ka pani, as they say. So Opco represents the more valuable component, which is the excess return on invested capital, which we highlighted in the previous slide as the top attribute that we look for, whereas Finco represents just the dumb capital. And as you see in the box at the bottom, we denote value as comprising of these two components, the invested capital plus value of excess return on that invested capital. So on over 500 companies, the team has, over last various years performed this, and this split of the value provides very useful insight. हर एक कंपनी में कितना दूध है, कितना पानी है, वो इससे हमको insight मिलता है. Obviously, the excess return component, the Opco, is highly valuable business. It can be worth 20, 30, 40, 50 times or more the cash flows, whereas the invested capital is a very low multiple. Since it's dumb capital and their return on capital equal to cost of capital, uska multiple, depending on the cost of capital, if you take 11%, then it is a 9 multiple business, very low multiple. Once you have this split, you also can equate it to the market determined enterprise value, which is market cap plus debt. And by equating the two, you can then derive what is the capital light price to free cash flow multiple, which is the bottom row in this slide. Capital light price to free cash flow multiple of the OpCo is equal to the market implied value of OpCo divided by capital light free cash. In the interest of time on this format, I won't go into greater depth, but I would say this multiple is what we use for comparing across companies within a sector as well as across sectors. This is a more logical and apples to apples comparison instead of PE multiple, because this way you normalize for capital structure of every company as well as you normalize for capital intensity of the various business models, both of which are not normalized for in PE multiples. Amongst the various other shortcomings of PE multiple, these two are most crucial in our mind. To illustrate, let's go to slide on portfolio composition, would just illustrate what difference it makes to look at things this way. If you look at the bottom right hand side where Vivek is highlighting, on FY22, because 21 is a washout year, on FY22, the Sensex is, in our estimate, trading at 19 plus times PE multiple, but it is trading at 36 times nearly on our clear price to free cash flow multiple. Now, when you're comparing a consumer staple company, pick a name like, say, Nestle, and 2.5 years ago, when the team was looking at it and when they bought it, the company's valuation was at 44 times or so PE multiple, 45 times call. Compared to the 20 times PE multiple, which was the case then as well, it appeared like 125% premium, which sounded too high to many, and that was the general pushback that it's the best company in India, but trading at 125% premium. Whereas how the team would look at it is that it was trading at 48 times capital light price to free cash flow multiple compared to 36 times for Sensex. So it is at a premium, but only 33% premium, which is a very small premium to pay for a great company, great franchise like Nestle. And it also showed good upside on DCF value and hence made it an attractive candidate. So that's the practical use of the framework, how we practically put it in use on the team. While I'm on the sheet, let's also look at the portfolio composition. So as I was saying, on the top half is the sectoral composition. So while one may see here and say, oh, financials is 33%. Yes, because, as I pointed out earlier, just because there are headwinds, first of all, to the sector on the operational front, doesn't mean it's a sector to avoid, because valuations might have become for some of the companies compelling enough to look beyond the next year or two. And as I said, those who survive next 2 years would thrive over the next 2 decades. From that perspective, many of these provide very compelling entry points to add to the positions. And within financials also, as I highlighted, there are insurance companies and other segments, asset management companies, which are in fact beneficiaries of heightened risk aversion that you're going to see post-pandemic. So you can't club them together with other lending institutions like banks and NBFCs. Also within lending institutions, also you have big differences. On one extreme, you have microfinance companies which are lending to the bottom of the pyramid segments, loans of the size of 30 to 40,000 rupees without any security. On the other extreme, you have gold lending, or lenders who lend against gold. There are some of these listed players in there who have fully securitized collateral, lending to the similar strata, 30 to 40,000 rupees, but hardly have to worry about any losses because they are over collateralized, especially given that gold prices have gone up. So huge differences in business model, even though they may sound so similar. So, and that is the value add of active management, in my view, not to go from a top-down perspective that financials are bad, so reduce the exposure to that sector, but instead identify where opportunities may exist and be appropriately valued. Other sectors you'll see broadly well invested across sectors. We don't own anything in energy and utilities because just We don't find, happy to answer any questions in that regards, but we don't find companies that meet our investment philosophy in those sectors. So the team has not invested in those sectors over the last 2-3 years. Otherwise, you'll see healthcare, IT, and across board, good exposure. Lower left-hand side box shows the mix of large, mid, and small. So we are at this time roughly 70% in large cap and close to 30% in mid and small put together. It's a little bit higher than usual in large caps, I would say, but it's more driven by the fact that the team has had strong performance in some of the mid cap names year to date, as well as on the overall portfolio, but driven by some of the mid cap names, which given their strong outperformance has gone from mid caps to large cap bucket. Otherwise, most of the time we have 60-40 split, 60% in 50 to 60% in large caps, and the remaining 40-50% in the mid and small cap put together. We're going to pause at that and open up, turn it back to you. I'd love to see if there are any questions, happy to address, and I'll try and be brief so that we can address as many questions as there might be.
Fine. Before opening the session for question, I mean, we have already collected few questions from the participant earlier. So we have shortlisted a few questions, and let's go one by one. And if time permits, let's take a question open from the session itself. So before taking the questions, I mean, Mr. Khemka, I appreciate for taking the time, sharing your investment approach and your philosophy, and also broadly covering about economy and markets.
My pleasure.
Yeah. So the first question is the take on PSU banks. Like, what do you think of PSU bank and other beaten down PSUs? Mentioning few names like BSU, Coal India, and etc. as an investment idea. So this is the first question, Mr. Khemka.
Sure. So on PSUs, first of all, let me say that the team has not invested so far over the last 3 years in any of these names. And without going into India-specific PSUs, let me draw from my experience of having invested in developed markets around the world, as well as global emerging markets, about 30 countries from Mexico to Korea. What I learned and realized was that around the world, the government-owned companies, and some of these, India is that way, fortunate, Indian market, I would say, is that way fortunate that government-owned companies add up to only single-digit percentage of the market weight. But in many of these countries like China, till not long ago, government-owned companies were 2/3 of the market, right? And in Russia, Poland, and so on, still continue to be very high proportion of the market. Having looked at these across countries, I realized everywhere they suffer from a few basic problems, in that the controlling shareholder is not aligned with minority shareholder. And the management is also not aligned with minority shareholder. Management is aligned with the controlling shareholder, which is the government of these countries. Now, the governments around the world, their priority is the public at large. Either you can call it social service or whatnot. In other countries, in Latin America, I found the priorities were the priorities of the political party in power, if you will. But nowhere did I find company that was government owned whose priority was optimizing or maximizing return on incremental capital for shareholders. That being the fundamental first attribute that we look for. We have not been able to find historically, we never say never, but historically not been able to find attractive investment opportunities in that segment. Now, one may say these are beaten down so much, isn't all this reflected? So this could be over short periods of time, and these short periods of time can extend 5 years, 10 years, or so on. But in our view, there is no way, based on our philosophy at least, of generating outsized returns by investing in PSUs anywhere in the world. I'm not talking India specific, but anywhere in the world over a sustained long period of time. I hope that addresses the question.
Yes, yes, Mr. Khemka. So I'll move on to the second question. So the next question is on the announcement of the stimulus packages. So the question is that we have seen countries globally, including India, announce stimulus packages. What are your views on this announcement, and what role does it play to drive future growth?
Certainly. So I'm generally not in favor of fiscal packages. I'm talking about not this pandemic, but in general, not in favor of fiscal packages, because like has been taught to us since childhood, कि पैसे झाड़ पे नहीं उगते. Money doesn't grow on trees, right? So any dole outs that are given, which is what fiscal stimulus generally ends up being, that money has to come from somewhere, and typically it would come from taxpayers, where 2, 3, 4% of people or corporates or entities in the country who pay taxes. Ultimately, the burden would fall on their shoulders. These are companies who historically they are in a tax-paying position because A, they're compliant and honest, and B, they are creating jobs while developing, while creating value, right? In the society, for the society. These are the best allocators of capital, in my view, looked at from whichever perspective. Taking money away from them, anyone who takes money away from them is likely to do a suboptimal job in allocating or distributing that money, right? So that is the general perspective. In times of such crisis, there is a humanitarian need, but that need is basically to provide some basic sustenance amount of money to the poorest of poor people, right? So if there can be effectively done by transferring or something, I'm supportive of that. But otherwise, not in the camp, which seems to be the majority camp, of giving large dole outs to the industry to spur the economy. While it sounds very good, but there are massive leakages. I mean, just inefficiency. I don't mean to say leakages in a negative sense, but inefficiencies in that process. And structurally, it's not a desirable thing in my view. What is the need of the hour instead of fiscal stimulus is a huge reform stimulus. Last time we had a crisis anywhere close to the current crisis is in the early 90s of a different nature, and that led to a huge reform push and liberalization. That is again the need of the hour. Some of those steps the government has announced with relates to the agriculture sector and whatnot. I hope that and expect, and I'm very optimistic of the government doing more of the same across various facets of the industry and the economy, and that doesn't cost any money, and that is far more positive. Not only structural, that's a much bigger positive stimulus, not only structurally from a long-term perspective, but also in the very near and immediate future as well. Would lead to sustainable job creation as well.
Nice, Mr. Khemka. So the next question is on the valuation level. So given your experience investing in developed and emerging markets, what are your views on current valuation levels, and do you see a risk of reset to lower valuation levels?
So, see, valuations are all relative in my view. And the biggest benchmark is the 10-year bond, US 10-year bond. So when I went to study to the US in the mid-90s, the long bond was, pick a number, around 5%. So if you think of the multiple on that 5%, the bonds, long tenure bonds were trading at 20 multiple in the US. Today, the same are at 1% yield. So 1 to 2%. So effectively, the multiple has gone from 50 to 100 multiple on the bonds, right? And that is the benchmark for valuation of all other assets. Equities, S&P 500 in the US at the time in mid-90s was trading at 15 times or thereabouts, mid-teens. Today, they've gone from 15 times to 20 times. Yes, that is it is at the high end of the historical range. But when you look at the comparable benchmark, which is the bonds, they are trading also at 50 to 100 times, which is at the very high end of the long-term historical range. So till such time that the bond yields are as low as they are, it's difficult to expect, while there can always be a scenario that becomes easy to expect, but at this time it's difficult to expect that other asset classes remain at lower multiples when the benchmark itself is at such higher multiple. And why is what can take bond yields higher, meaning the bond multiple lower, is basically inflation. What the asset prices around the world are telling us is in true inflation expectations for the markets are close to non-existent or zero, right? And when you try to triangulate or rationalize what is such expectation based on, you look at, let's think of inflation. The two major sources, primary sources, are commodity inflation and wage pressures. Commodity inflation, the biggest driver is fossil fuels, crude or other fossils. Now, with the discovery of shale oil in the US, that's like they have become the marginal price setter. It's no longer the cartel. And so there's a cap on oil prices that have come in. And obviously, currently, the prices are even lower than the cap. So sustainable inflation in fossil fuel prices becomes very difficult to expect at this time. And hence, the commodity-led element of inflation pressures or inflation expectations has pretty much disappeared, and rationally so. Seems rationally so. Other wage pressures, if you think of, before the pandemic, the US had lowest unemployment levels in a long time, but there was hardly any wage pressure. And if you try to understand why that is the case, you look at companies like Tesla or companies like Uber or other companies which are like Google, which are working on all of them working on leading edge technologies, and that is why they are valued. The drone technology and delivery, driverless technology, autonomous driving, all these are deflationary, because if you have driverless cars everywhere and trucks everywhere and deliveries everywhere, you would not need as many people, workers, as you might need currently. So these are all deflationary pressures. Technology advances are deflationary in nature, as well as they have been over the last many decades. So combination of reduced expectations on wage inflation and commodity inflation, the inflation expectations worldwide are very low. Increasingly, there are more countries who are worried about deflation or no inflation or lack of adequate inflation than countries worrying about higher inflation or hyperinflation, particularly in the developed world. And that is what the bond yields are reflecting when they are so low and even negative in many countries. Because if there is no inflation, the bond yields can be, or inflation expectations are, say, zero, bond yields are likely to be negative.
Interesting, Mr. Khemka. So the next question is, quite interesting. I know that, you have wide experience throughout in managing equities, but this question is that, would you recommend investing in debt or equities at this point of time? I would expect, bias-free answer, Mr. Khemka.
So, sorry, you caveat bias-free answer. I would caveat that I'm inherently biased. Last 35 years at least. That's a host sambhala, if you will. I have been fascinated with equities, and almost all along, I've been, say, about 100% invested in terms of my net worth in equities. I have never invested in fixed income or fixed deposit. Maybe कुछ एक दो हफ्ते के लिए कभी पैसा पड़ा रह गया बैंक में. That's a different matter. Again, this is not the right forum, but I do often talk about to clients that investing in debt to me is guaranteed real loss. Not guaranteed income, but guaranteed real loss. In real terms, you lose money, because after paying taxes and adjusted for inflation, there's nothing left. In fact, you have a negative hit. So you can't keep up with inflation over time. Most people can't keep up with inflation over time. Whereas equities are uncertain but compounding gains. Now, for different people, they must decide for themselves with advisors like yourselves and other advisors, what's the right asset allocation for them. Like for me, it is, say, 100-0 in favor of equities or thereabouts. And different people should decide for themselves, but recognize that whatever they keep in the so-called safe which is no longer safe anymore, as we've realized as well. So not only it may not be safe, it is expensive as well. In that, after adjusting for tax and inflation, you are likely not keeping up. In real terms, you are not growing that wealth. So there's a certain cost attached to the comfort of safety, perceived safety.
Thank you. Thanks for being frank on that. Mr. Khemka, the next question is, most of the portfolio managers were overweight in banking and NBFC before this, pandemic. And post this pandemic and this moratorium period further extended to 3 months, there have been notable shift from banking and NBFC to other sectors. So what's your take on that?
Certain. So I shared our portfolio. First of all, I just shared our portfolio, and there you see that we have very sizable. The team has very sizable investment in financials. I think probably it is similar. I don't know off the top of my head. I'll have to check, but it's similar to what it was prior to pandemic. So I mean, the statement may not be generally applicable to everyone, but let's take that as a generalization. See, remember and if I were to defend the industry peers, see, going into before the pandemic, nobody, no individual investor and no company could have envisaged such a scenario. Like if you talk about 6 Sigma events, this is a true 6 or 7 Sigma event or whatever you may call it. Now you may say, yes, there are other events that keep on hitting the industry or the country or the economy, even though they may not be the same kind. And financials being leveraged companies, they are most susceptible to any crisis, and this crisis showing to be the same. But once a crisis, even if let's say the industry at large of managers at large were mistaken, let's take that as a granted in having such high exposure to financials, at least once it becomes apparent post-pandemic that they would be more susceptible, it's reasonable then that when facts change, that you should change your position. It will be even dumber to not change your position after such a risk as it. And as I highlighted, you can't paint financial as a sector with the same brush. There are companies within financial sector which are outperforming not only the financial sector year to date, but outperforming the market in general. In fact, there are financial companies like some of the gold lending companies are up for the year to date. They're positive returns year to date, despite financial as a sector being down 40%. And there are other financial companies that are, barely down or down single digits or down low double digits. And so there's great risk in painting a sector with a broad brush. There are nuances, differences, which is what we all get paid for, right? To capture and identify those nuances and differences.
Right. So, Mr. Khemka, the next question is from my side. Initially during introduction, I've been giving brief about White Oak. The size of manages 1.7 billion USD. So, in the interest of the participant, would like to know about the size of your team and strength of your team. So, if you can able to share your perspective about your team, I think it will be great takeaway for us.
No, certainly. So I believe my biggest accomplishment over the last 3 years has been to put together the team that we've put together. It's an outstanding team in my view, and here you might say it's my biased opinion, but be that as it may, in my opinion, it is the best team in the industry. It's certainly most well-resourced. We have a 12-member team, and Vivek, if you are on, you may want to pull that slide up on the screen as well quickly, but I won't take too much time because you run the risk by asking this question that I may take the entire rest of the time, but I'll limit myself to 2 minutes. It is a very well-resourced team, 12 members, average experience of 15 years, many of the seasoned investors. So let me summarize 3 key attributes without going into the background of individual team members, as it would be very time consuming. The 3 key attributes of the team, I would say, is very seasoned team. Many of the individuals on the team have seen multiple cycles, including the Harshad Mehta scam of the early 90s, the dot-com or the TMT bubble at the turn of the century, the Lehman Brothers crisis, and now the COVID crisis. There is deep and broad expertise on the team. Second unique attribute is several of us are have experience investing around the world, in developed world as well as emerging markets. So I myself have managed as a senior portfolio manager, managed US portfolios of several billions of dollars in when I was in the US, and also been prior to that at State Street Global Advisors managed. So the US management was US equities was while I was at Goldman Sachs Asset Management, and prior to that when I was at State Street Global Advisors, also looked at and managed international developed portfolio, and then global emerging markets for 4 years as well. As I said, with nearly 30 countries from Korea to Mexico. And there are other members on the team who have experience investing in Asia, experience investing in Latin America, Europe, Africa, and so on, which is unique aspect of our team due to just the background of people on the team being what it is. So that's the other attribute I'd like to highlight. And the third attribute, it is a very deep team with very deep decision making runs very deep into the team. It is not a team led by the one person at the top with other just supporting, but it is in true sense a team where there are many decision makers. In fact, every individual on the team is a decision maker in their own right. So it is not dependent on one individual, and it's not the portfolios don't hence suffer from mistakes of one individual, but the decision making is pushed down to the experts who are closest to the companies and sectors that they are covering. So these three attributes put together, the seasoned nature of the team, the global expertise or experience, and the decision making at the team level, makes our team uniquely equipped and in the industry, and is key reason. Saying key reason is an understatement. The primary reason for delivering the performance that the team has delivered.
Thank you, Mr. Khemka. And let me take the last question. Perhaps we have received a couple of questions in the forum. So let me take at least one question from the forum. Due to time constraint, I don't think so we can go beyond this one question. So just hold on. Let me take up the question. Yes. So what is your definition of outsized return? And how much percentage of outperformance versus index does White Oak target? And what is general average holding period of White Oak?
Certainly. So definition of outsized return, the return of White Oak, and third was holding period. So let me take the first one first. Outsized return, according to the team, over time, what the team aims to deliver is the best return compared to anyone else in the peer group over any reasonable time period for our clients. In our observation over the years, to do, let's say, to perform in the top 1 percentile, not top quartile or top decile, but to perform in the top 1 percentile of the marketplace and the peer group, 1,000 basis points of alpha or 10 percentage points over and above what the market has delivered would put you in the top 1 percentile over long periods of time. And so to us, that becomes the goal, and that is what we would consider outsized return, meaning 10 percentage points higher than the market. Going forward, hard to say what the market would deliver. But if you assume, so last 35 years, as I was quoting earlier, or the time frame I was using earlier, over the last 35 years, the market has delivered probably about 14% or so. Because economic nominal GDP growth rate has been about 13 to 14% as well, and corporate earnings growth has been in that ballpark. Going forward, if you were to assume that the real GDP growth rate is a little lower and inflation is a little lower, so nominal GDP growth rate and hence corporate earnings growth rate and hence returns from the market might be lower than what you've seen over the last 35 years. Call it about low double digits or 11%, 10 to 12%, call it 11%. In such scenario, we believe to deliver peer group leading performance, manager would have to generate north of 20% absolute return, about 10 percentage points outperformance. And that is what we would consider outsized returns. How the team has done over the last close to 3 years, because the team started end of August 2017. So far, they have delivered more than 10% outperformance, consistent with what our aim or expectation is. Obviously, the market over time has been very difficult. So the market is depending on the starting, but as of end of April, the market was over this time period of nearly 2.5+ years has been negative. If my memory serves right, it has been -2% annualized, whereas the team has delivered close to +9% annualized, delivering a 10 to 11% outperformance for the market, which has put it in the top 1 percentile or thereabouts. That is the two questions. And then the third question, I believe, was on holding period. So when we buy a company, when the team buys a company, it believes like a marriage, it's never going to separate from it. But the team is very valuation sensitive. We buy something when there's a 50, 60, 70% upside. But because of, as an example, the stock outperformance and that valuation gap is narrowed down or closed, then the team does not hesitate from trimming or selling out of such investment to redeploy that capital elsewhere where they see more upside in a stronger business or just as strong a business. Given this, we expect over time the name turnover based on past experience and observation and track record. We expect going forward also the turnover to be about name turnover to be about 30%. So to your question of average holding period for a name, we would expect to be about 3 years going forward, plus or minus a little bit. Some companies we may own for decade or longer, and other companies we may own for much shorter time period. But that's the average holding period to be expected.
Thank you, Mr. Khemka. We have a couple of questions. So what I can do is that, I'll share the questions to you. I would request you to, address this question in next couple of days so that from PMS Bazaar, we will revert to the participant who are all these questions. So Mr. Khemka, thank you very much for taking your time. So let's wind up, and participant, thank you very much for taking your time participating in this session.
Thank you, Pallav, and I want to again thank all of the participants who dialed in and shared their evenings with us. Thank you. Appreciate it. Bye-bye.
Thank you. Bye-bye.